Welcome, everyone. Thanks for joining us. It's Taylor Hudson, joined by Hugh McNaughton, August 10th, 2012, for Sprague's Market Brief. It's been a while. It's not my fault. Hugh's been on vacation for the last month. He's finally back to work.
That's because he has the microphone, boys and girls.
But today we're gonna change it up a little bit today. Instead of boring you all with slides and movies, we're just going to have a little roundtable discussion here, Hugh and I, and see how that goes. So you can do something else while you listen to this. There are no exciting pictures to look at. So Hugh, I thought we'd start off with a couple of topics that we've touched on over the last few months and maybe provide a bit of an update on. First one would be the ultra-low sulfur heating oil in New York Harbor, or in New York, I should say. And what we're seeing going on with that. So my first question to you would be sort of the one that was on everybody's mind before the switch over, and that is, would there be enough ultra-low sulfur diesel around to satisfy demand? What are we seeing down there?
I think we're seeing enough ULSD around to satisfy demand, Taylor. But the interesting thing is it's coming at a cost, and that's not surprising. Obviously, you suddenly got a big incremental load in terms of demand for ULSD, which you didn't have before. You're going to see the differential between the ULSD and the regular heating oil widen out. But there seems to be enough. What's your take from what people you're talking to?
Well, a lot of dealers expressing concern over the availability of distillate generally going into next winter. It's funny, a year ago in the fall, we talked a lot about would there be enough distillate around should people lock in basis? Then we didn't have a winter, so basis really wasn't a problem. So I hear a lot of people asking similar questions this year, and they tend to have heard something about the ultra-low sulfur diesel transition in New York Harbor, or in New York State, I should say, and they're now projecting that to, well, will there be enough high sulfur material in Providence? Will there be enough high sulfur material in Portland? And I think, generally speaking, we think there will be, but like you said, it would come at a cost. So right now we're seeing about 11-cent difference in price, I think the last time I checked, between high sulfur material in New York Harbor and the ultra-low sulfur material. Whether or not that lasts into the wintertime, we'll see. Do you think it will, or do you think they'll come closer to parity, Hugh?
You know, that spread fluctuates all over the place, as you know. I mean, historically, to my mind, something between 5 and 7 cents is the norm. But there's nothing at all to say that 11 cents or 12 cents is that unusual. A function of harvesting and other requirements. But then again, under these circumstances, with the sudden manifestation of demand for what used to be high sulfur heating oil, now on ULSD, I don't think it's terribly. I don't think there's any reason for alarm. And I also share your opinion that we're not looking at any shortfall in either one of them going forward.
Okay, let's jump back a little bit to sort of the macro picture and pricing in general. A couple of topics here. Iran. As far as we know, last time we checked, the Straits of Hormuz are still open. I've read some articles that suggest the sanctions against Iran are working well, some which suggest they're not and they should be tightened up. Anything new on that front, Hugh, going on with the Iranians?
Well, either the world or the part of the world that's opposed to the Iranian nuclear program, enrichment program, is turning a blind eye to the fact that time is just going by, and to the best of our knowledge, we don't see any Iranian nuclear physicists emigrating to the U.S. because the career opportunities are better here. But and at the same time, it seems to be in abeyance, as if hopefully these negotiations are progressing, at least to the extent that we, as in the West, would like to think they are. Then, of course, as we were discussing before this, you have these little rumbles out of Israel, which I think you came up with the article today. And what was that about? That was about
I didn't read it. I gave it to you.
Oh, I see. Let me see. It was to the effect that the Prime Minister, and I'll never be able to pronounce his name, Netanyahu,
Yes.
and I think it's Defense Minister, Ehud Barak, are apparently, according to this Jerusalem newspaper or Israeli newspaper, in agreement that a preemptive strike is appropriate. It should, in fact, be it should be carried out here before the election, before the U.S. elections, but that the plan is lacking enough support in the rest of the Israeli cabinet, and I think on the part of the Israeli public as a whole, to really follow through. And not to mention the fact that obviously this would be present a potential serious rift between Israel and its major ally, the U.S., if it was to go ahead, and especially if it was to go ahead and not be successful.
So it sounds like the issue will be with us for months to come, and just sort of the headlines on a day-to-day basis may swing this market. Another summertime favorite, not favorite, but another summertime issue to deal with is hurricanes. We had our first sort of market attention-getting hurricane, Ernesto, now traveling over Mexico. This morning we had tropical depression number 7 form, and there's a new area of disturbance just off the African coast. Anything new we should be aware of on hurricanes, Hugh?
Well, no doubt, as you've just implied, Taylor, always an issue at this time of year. And even though you got, even though in my opinion, refineries and production levels are precautions are way superior to where they were back in when we had Katrina and what was the other one? Katrina and Rita. Yeah, where key refineries were flooded out and shut down for several weeks. I'm not sure that that's really that much of a risk anymore. But as we also discussed before this, there's now this revised U.S. meteorological report, weather service report, that we're going to have an even more active season, even though we're halfway through it. At least chronologically, we are, and that doesn't bode well for the rest of the year, does it?
So since we last spoke and you went off on your vacation, the market's been on an absolute tear. June 25th for heating oil, heat traded 251. Today's scratch high was 306. That's an increase of 55 cents. Gasoline over the same time period, 254 to 303, let's call it. 60 or 49-cent increase. Cost me $60 to fill up my sedan the other day. That's what I always use the $20 rule when it takes three $20 bills to fill up your car. Now we're going to start hearing about it on the news. And the one that's your favorite is Brent crude. We monitor that closely here. $88 at its low in late June. Now trading 113 and a half, $25 uptick. I guess several factors at play, Hugh, but let's take them maybe one at a time. In the U.S., we've gotten some news. Jobs number came out last week. What's the U.S. looking like right now?
Well, like you said, there was that encouraging jobs number. I don't know how, given my mythical vacation here, I actually saw that. But anyway, there are slightly better indications of some economic growth in the U.S. No doubt, there's no doubt also that's encouraged some of this market appreciation that you mentioned.
How about over in Europe then? That's the second one that everybody is this getting any better? Is it getting worse? What's the status with the Europeans?
I don't think it's getting any better, Taylor, unless you see some sign that there's an improvement over there, not in terms of the bond cost or anything. Our colleague Seamus Martin today was pointing out, though, that between Mario Draghi, the head of the ECB, and Angela Merkel and François Hollande, there seems to be a fairly concerted agreement that something's going to have to be done. Something will be done. They will do whatever's necessary. If that's the case, then maybe there's a hope for some kind of improvement over there.
Is it a situation, though, that they solve perhaps a debt crisis, but that doesn't necessarily get rid of the fact that Europe's in recession and therefore oil demand may be lower over the coming months?
Absolutely. There's no indication at all that there's any short-term solution to their economic issues, and that's going out through 2013, and I think that's every day. It's increasingly recognized in terms of revisions by the IEA, by OPEC themselves, in terms of demand going forward.
Well, we've just spent over a minute talking about how bad things are in Europe. How come the market's rallying, Hugh? There's the $64,000 question for you. Anything that we are overlooking? I mean, it seems to me like a lot of these issues were present with us in early June when the market couldn't find a bottom.
Yeah, isn't that ironic? Well, what is ironic is that the worse the economic news gets, the more support is generated by in my opinion, the only factor secondary to this tight North Sea crude oil that's driving Brent, and that is anticipation of economic stimulus programs. The worse it gets, the worse anybody's economy, China, U.S. or Europe gets, the more investors seem to take encouragement from the fact that it leaves the central bank authorities with less and less option except to interject some liquidity. Is that your opinion as well?
I guess it's a good point, and as we were talking earlier, I guess it suggests that the market seems to only be able to find a way to sell off in between bad economic news and policymakers promising to do something to make it better. So if anyone wants lower gasoline, diesel, or heating oil prices, it may only come if the stock market panics, we get some bad economic news, and politicians are not quick with a monetary policy response. We certainly know that we're not going to get any fiscal policy response any time between now and the election, certainly. But if the central bankers stay quiet on the topic, then the market tends to be a little frightened, and that's when we get and certainly we get the pullback. I do want to just touch on that Brent loading program. So you said that there's less output right now in those Brent fields. Can you just give me a little bit more on that?
Yeah, Taylor, I think this is the biggest and maybe under-recognized factor, certainly the biggest factor behind the strength in the current market. This Brent group of 4 crudes in the North Sea, probably responsible for pricing 60% of the world's crude oil supply. Is reduced basically to a trickle. It's at historically low levels. It's this September going to be 700,000 barrels a day. That's as opposed to a historical 1.4, 1.5 million barrels. It's naturally reducing or declining because of output, but this is due to very heavy maintenance of those fields. As a result, we've got a hugely, in my opinion, overvalued Brent crude oil. And again, given the dominance of Brent now as the world crude oil index, we have, as you point out earlier here, we have $112, $113 Brent, probably $12, $13 more than perhaps it might be otherwise.
Okay, lightning round. 2 weeks out, Hugh, we get back together. Higher or lower? Use heating oil. We're trading around 306.
306.
Complete guess here. Come on, what do you think? Higher or lower?
Back to the wall, lower.
Don't look at my answer.
Back to the wall, lower, and I didn't see your answer.
I agree. I think the recent run is probably overdone. I'd say we're back to 290-ish in a couple of weeks. So not a heck of a lot.
I like it.
All right. Thanks, everybody, for joining us. And, again, please send us an email if you'd like us to discuss something in particular. Have a great day.